At this very moment, the IRS is holding $4,873 that belongs to you. And if one specific form is not submitted before the statutory deadline, that money disappears permanently. No extension is available. No appeal process exists. No recovery is possible once the window closes. This video exists to make certain that outcome does not happen to you. Here is what the majority of seniors are never told. The IRS does not mail you a check. The IRS does not place a phone call. The IRS does not send your tax preparer a notification. There is currently more than $1 billion in unclaimed refund money sitting inside federal accounts right now. Every dollar of it belongs to real individuals who qualified, who earned the right to it, and who simply never submitted the form that initiates the payment. The system operates on a single principle. You submit a claim, then payment is issued. You do not submit a claim, and the money transfers permanently into the United States Treasury. After that point, no legal recourse exists. The commercial tax preparation industry, which generates $14 billion in annual revenue, carries no financial incentive to simplify this process for you. The more complicated the system appears, the more seniors continue paying for assistance they may not require. Understanding this dynamic is the first step toward reclaiming what is yours. The most painful pattern in this area of tax law is not fraud. It is not negligence. It is seniors in their 60s and 70s who qualified for a fully legitimate IRS credit, whose money was sitting in a federal account specifically designated for them, and who never submitted the form because no one ever informed them it existed. That is the most financially damaging category of mistake possible. It generates no penalty notice. It produces no letter from the IRS. There is simply money held quietly in a federal account that never reaches the person it legally belongs to. The IRS will never notify you that you missed it. The gap between what is legally available and what actually gets claimed is not an eligibility gap. It is a knowledge gap, and that gap costs seniors real money during every single filing season. That brings us directly to the two groups who leave this money behind year after year because both have already reasoned themselves out of filing, and both have reached the wrong conclusion. The first group is the existing filer. She submits a return annually. She works with a CPA or a national tax preparation service. She operates under the assumption that if a credit were available to her, her preparer would have identified it. That assumption is costing her money. The Earned Income Tax Credit does not apply automatically. It must be specifically triggered on the return. Many preparers complete the return accurately in every other respect and simply never run the EITC eligibility check for a senior filer. The preparer made no technical error on what was filed. They simply did not examine the provision that was not part of their standard workflow. The second group is the non-filer. Her income falls below the federal filing threshold. She has not submitted a return in years because she is not legally required to do so, and she operates under the assumption that if she owes no tax, there is nothing to be gained from filing. That assumption is equally incorrect. Low income is not a disqualifying factor for this credit. In many cases, low income is the precise qualifying condition. Filing a return, even when no tax is owed, is the mechanism that releases the refund. No one who completes this video should conclude that this situation does not apply to them. Both groups arrive at the same incorrect conclusion through different reasoning. Here are the exact figures, because the numbers are the fastest way to verify this for yourself. The IRS establishes maximum credit amounts by filing category. For a single filer with no qualifying children, the maximum credit in the current tax year is $632. For a filer with one qualifying child, the maximum is $4,213. For a filer with 3 or more qualifying children, the maximum reaches $6,960. The income thresholds for qualification are below $18,591 for a single filer and below $49,084 for married filing jointly. An investment income ceiling also applies. If investment income exceeds $11,600 in the tax year, qualification is eliminated regardless of earned income level. That figure must be verified against your actual account statements, not an estimate. One detail seniors consistently overlook: Social Security income alone does not count as earned income for this credit, but receiving Social Security does not disqualify you. If you have any earned income in addition to Social Security, part-time employment, compensated childcare for grandchildren, occasional service work, income from selling items, you may qualify, and the calculation must be performed. Small amounts of self-employment income open the eligibility door. For a lower-income senior, the $632 floor for a filer with no qualifying children is the minimum, not the ceiling. The actual credit is determined by your specific earned income calculation, and for many seniors in lower income brackets, the final number lands considerably above that floor. For the more financially comfortable retiree, the $49,084 married threshold confirms that this is not a program restricted to seniors in financial hardship. A retired couple receiving pension distributions, modest Social Security, and some interest income may still fall within qualifying range. Run the actual numbers before self-disqualifying. Pause right now and retrieve your most recent tax return or your current Social Security statement, not your estimate of your income, the actual figure on the document. Locate the adjusted gross income line and compare it against the $18,591 or $49,084 thresholds. What follows depends entirely on where that number lands. The first form is Schedule EIC. It attaches to your standard federal return, Form 1040. Schedule EIC is not submitted as a standalone document. It attaches to the 1040 and initiates the IRS eligibility calculation. Both forms are available at no cost on irs.gov. No third-party services required. No filing fee applies to accessing these documents directly from the IRS. The second form most seniors never encounter is Schedule R, the credit for the elderly or disabled. This credit has existed in the federal tax code since 1976 and was designed specifically for seniors living on fixed incomes. It is among the least claimed credits in the entire tax code, not because few seniors qualify, but because most preparers do not navigate to it as part of a standard return preparation process. If you are age 65 or older, Schedule R should appear on your return. If it does not, ask directly why it was omitted. The 2025 tax year includes a new senior bonus deduction that reduces adjusted gross income. That reduction can move seniors who previously calculated out of the Schedule R credit back into qualifying range, particularly within the $20,000 to $35,000 income bracket. If your preparer has not raised this, ask them the following question directly. Did you run Schedule R with the updated AGI after applying the senior bonus deduction? A preparer current on 2025 tax law will answer that question immediately and specifically. A preparer who is not current will provide a vague response or show uncertainty. That answer reveals everything you need to know. There are 3 sections on Schedule EIC where seniors make errors most frequently. The first involves the earned income calculation. Earned income for this credit means wages, self-employment income, and certain disability payments. Social Security benefits alone do not qualify as earned income for EIC purposes. If Social Security is your only source of income, you do not qualify. If you have any earned income alongside Social Security, even a modest amount from part-time work or self-employment, you may qualify, and the calculation must be performed accurately. The second common error is leaving the investment income line blank or underreporting that figure. If investment income exceeds the cap, the credit is eliminated entirely. That number must be precise. The third error involves filing status. The filing status recorded on Form 1040 must match the status recorded on Schedule EIC exactly. Discrepancies trigger processing delays, and in some cases automatic disqualification, requiring an amended return to resolve. If filing assistance is needed, 2 free programs serve seniors specifically: VITA, the Volunteer Income Tax Assistance Program, and TCE, Tax Counseling for the Elderly. Both are IRS certified and available at no cost. TCE, operated through AARP TaxAid, specializes in retirement-specific tax questions, including pension income, Social Security taxation, Schedule R, and EITC eligibility for seniors. AARP membership is not required. Search irs.gov for VITA locations near you, or call 800-906-9887 to locate the nearest TCE site. Now the deadline. This is where individuals who believed they were safe discover otherwise. The IRS enforces a strict 3-year look-back window for unclaimed refunds. Once that window closes on a specific tax year, the refund is permanently forfeited. The funds transfer to the United States Treasury. No appeals process exists. No exception applies to seniors. No hardship waiver is available. The window closes and the money is permanently gone. The 2021 tax year deadline falls in April 2025. If the earned income tax credit or the Schedule R credit was not claimed on your 2021 return and you qualified, that window is closing now, not next year, now. The $4,873 figure cited in IRS data represents the average unclaimed amount recovered by seniors in exactly this filing window when a return was submitted before the deadline. If you used a paid preparer in 2021 and the credit was not claimed, you are entitled to file an amended return on Form 1040-X. One critical point that costs most people the opportunity. Seniors routinely assume that a preparer's silence indicates they did not qualify. That is not what the silence indicates. Many preparers will file an amended return at no additional charge when the original omission was theirs. Ask directly. If they decline, the amended return can be filed independently through irs.gov. The IRS Interactive Tax Assistant tool, available free on irs.gov, allows you to verify eligibility for any prior tax year in under 5 minutes using your actual income figures. If the tool confirms you qualified for a credit that does not appear on your return, you have a verified missed credit and a clear basis for submitting Form 1040-X. The IRS will never inform you that your window is closing. Here is exactly what to do before the deadline. Step 1. Confirm your filing status for tax years 2021, 2022, and 2023. Retrieve the returns or confirm non-filer status for each year. If returns were filed, verify whether Schedule EIC and Schedule R were attached. If either is absent, an amended return is available. Step 2. Run the IRS EITC Assistant tool. Search irs.gov for EITC Assistant, enter your information for each tax year in question, and the tool returns a clear eligibility determination in under 5 minutes. Use the actual figures from your return, not approximations. Step 3. Gather 3 documents before opening any form. proof of earned income for the tax year in question, your Social Security statement, and your prior year return if filing an amended return. Step 4. For the 2021 tax year specifically, confirm the exact deadline for your situation at irs.gov under the unclaimed refund section. The standard window closes in April 2025. Do not assume additional time remains beyond that date. Step 5. Submit the completed Form 1040-X or original return directly through irs.gov or by mail to the IRS address listed for your state in the form instructions. Retain a copy of everything submitted and record the submission date. The IRS holds your money. The forms exist. The deadline is real. The only remaining variable is whether you file before the window closes. You now have the information to act. Like this video and subscribe to Retirement Watch USA so you never miss information that directly protects your retirement finances. If someone in your life is over 60 and has not heard about this, share this video with them today. It may be the single action that recovers their money before the deadline permanently closes.